Guys, you need to be prepared for whether the market spirals down or the market continues to ascend in 2024. So let's get right into the steps you need to take and what to be prepared for. There are two major stock market indicators that I always look at and Mo always looks at. The first one is the stock market GDP. And guys, right here, as of last Friday, with the S&P at 4720, we are 82% overvalued. That's with GDP skyrocketing because of inflation. Now, a lot of people argue with me, Paul, you can't look at the stock market GDP, blah, blah, blah. You might be right. Warren Buffett may be wrong. He says this is the most reliable metric at any given time to give some sort of valuation of the market. So for those of you who don't believe in it, I say, okay, let's just focus on earnings. Let's look at the 10-year cyclically adjusted PE ratio. What that does is it takes the last 10 years of earnings on the S&P, brings it to today in today's dollars with inflation, and divides the market price by that. Historically, the average is 17 on the nose. We're currently at 31.92 as of Friday, 87% overvalued. It's actually even worse than the stock market GDP ratio. The S&P earnings are down over the last year. Now, does that mean that 2024 is going to be a bad year? Not necessarily, Mo.
No.
But the funny part is, I've never seen anyone make a prediction about the future in the short run and it work out to be correct.
No.
Besides luck.
Yeah.
You know, and it's so funny. I see all these YouTubers out there saying, oh, in the first quarter of this year is going to shut the F up. Just stop. All I know is in the long run, stocks are a weighing machine. In the short run, they're a voting machine. And the votes rate recently have been very, very high.
Everything's for the market right now.
Everything is absolutely for the market. We see the VIX, which is the fear index, at 10-year lows. I don't know if it's 10, it might be that low. What that means is, and I saw an article recently that said, the VIX is at a low, this is a good indication for the future. Maybe. I see that and say, people are factoring in no fear. When that happens, usually it takes anything small to cause a trigger. Remember, guys, I do agree with John Hussman when he says so brilliantly that in a room filled with gasoline, with a fire in the corner, we don't know which spark will cause the explosion. All we know is there'll be an explosion caused by some spark. We don't know what it could be. Somebody said to me the other day, Paul, I don't see the catalyst. Well, we don't see, exactly, you don't see catalysts. That's what makes them catalysts.
Yeah.
That's exactly the point. Now, does that mean 2024 is going to be bad? Absolutely not. 2024 could be another huge year. Remember, a year ago, people couldn't imagine 2023 being a good year.
Right, in October, late October of 2022.
Rates had gone from 0% to at that point 4% or something like that.
Market was down big time.
Market was down big, tech was down big, and then all of a sudden you saw the mother of all rallies occur in an upward interest rate environment. But now we have the Fed talking about lowering rates for the first time in 18, 19 months. Powell actually said recently, hey, we could be lowering rates next year. And the bets are that the Fed said, what they do is they poll the Fed and they say, hey, the last meeting in September, they thought the average interest rate for 2024 would be about 5.1%. This most recent meeting, 4.6. That's a 0.5% lower. So Mo, what's the market betting on interest rates next year?
So the next meeting date is January 31st.
Right.
That's as far as the CME tool is projecting out. And it looks like we're going to stay the same for that first meeting.
So about 90%.
About 90%. You have 10%, though, saying that we're going to cut rates.
Which before it was like 1%.
It was like 1%. So that's a big number.
Yeah.
Big jump.
What happens if Fed cuts rates? Now remember, guys, I don't care whether the Fed cuts or whether the Fed increases rates, and I want you to get to that same place. And a lot of you probably already agree with that you don't care. But it's really important that we focus on dollar cost averaging and buying good businesses at good prices. But if Fed starts to cut the rates, like they kind of hinted at, Mo, this is what's confusing me, and I could be wrong. We still have core inflation at 4%. What's their goal?
2%.
I believe they're saying it's going to take a couple more years for that to happen.
Yeah. I believe if they start cutting rates, inflation will start to creep back up.
Not only that, what would have to happen economically for them to cut rates?
I mean, they've talked about it being kind of two-sided. Inflation comes down and unemployment also starts to move up. That's not happening. So if they cut rates without unemployment going up, what's going to happen?
Yeah. Low unemployment is inflationary. That's just a reality.
Exactly.
When too many people have jobs, it causes the demand for workers to go up. So what do you have to do then in order to get those workers out? Look at what happened after COVID.
Right.
We shut down and the government started writing checks to people for $600 a week, whatever the number was. So what happened to small businesses? They had to pay even more because the comment was, well, the government's paying me $600 a week, so if you're not going to pay me at least that, why should I come in? Understood. I get it from that perspective, but that's what makes low unemployment inflationary. If it's hard to get good workers, you got to pay more to the good workers. When good workers get more money, what happens to the bad workers? They get more money too. That's just a reality. The other thing is, for the Fed to cut rate, usually they cut when things are not the best economically.
Exactly.
So as a country, would you rather have a worse economic time, but cut those rates?
Their job is to be helping you borrow more money.
Yeah.
They shouldn't be helping you in really good times.
Yeah, it seems like, you look at this going, we're in really good times now, and we still have these deficits. It's just like, you look at it from that standpoint and say, why would all of a sudden thousands of years of economic policies suddenly change?
Like the whole thing about the Fed unemployment, it's just like a constant push pull, and it just seems like it's just a complete push or pull, whatever you want to categorize it as now.
Yeah, and I look
There's
at
no balance,
and I'm wondering. Our good friend Michael always says we're coming up to an election year, and you better believe those Congress people want to have a re-election. They want to be reelected. I don't know what's going to happen. All I know is that I look at what the Fed said recently, and I was like, well, that was quite the change.
Sure was.
That was quite the change.
Yeah.
Is it like 2018 when Powell was bullied by Trump to cut rates?
And he backed down.
So, guys, I don't know what will happen. Nobody in this world knows what's going to happen. There's a YouTuber that's very big who last year we had a meeting in September, October, and he literally said, like, with such confidence, the Fed will start lowering rates in the first quarter of 2023. Okay. Like, I remember when he said that going, how would you know? And guess what? It ended up being completely incorrect. They raised rates from there. So I'm looking at going, okay, what's going to happen? I don't know. But that's why dollar cost averaging is such a great thing. That's why if you want to buy individual stocks, buying individual stocks at good prices and learning a process is so important. Because if that's the case, a well-run business doesn't care where Fed rates are. And also, if you dollar cost average, you don't need to worry about where you go look at the last 42 years of history. Mm-hmm. We've had increasing rates, decreasing rates, world recession, all these things I talked about before. And guess where the market's gone?
Prices,
the market's up 40 times in the last 40 years or something close to that. I think the S&P was at 107 or 110 back in 1982, and it's now at 4,800.
Yeah.
You look at that saying, oh my gosh. Now, granted, we're coming off a major decrease in interest rates, which does inflate asset prices. You're going from 18% down to almost zero last year, pretty much zero. Guys, the other thing is 90-day Treasury is at 5.4%. We look at that going, if you're an investor and you've seen zero growth in the market for 2 years, a little over 2 years, you sit there and say, T-bills have beaten the market since November of 2021. And
not only that, they are effectively, let's just call it risk-free.
Yes.
I mean, you are basically going in and you're getting, for 90 days, 5.37% risk-free.
Annualized. So for those 90 days, you're going to get 1.4%.
The market's basically flat?
Yeah, flat. So T-bills have beaten the market over the last 2 years.
How would you not be in this?
Treasury bills. I love having the cash. I put it in T-bills. I get 5.4% every year.
These things were paying almost zero 18 months ago, 24 months ago.
Yeah, I was getting 0.06%.
Yeah, there was one day in there that it was actually negative.
Yes.
You gave the government money.
You gave the government $1 million, and they gave you back like $999,980, 3 months later.
That's crazy.
They gave you less money back. And that's the thing I want everybody, it's about understanding how your money works together. Mm-hmm. I don't want you worrying about interest rate cuts. I don't want you, in fact, if you're a long-term investor, which most of the people watching our channel are, you want bad times. You want lower prices for everything. So whatever everybody else wants, you should want the opposite. Because you're in accumulation mode. You're trying to buy the S&P. You're trying to buy those individual companies at lower prices. You're not trying to buy them at higher prices.
You want everything on a Black Friday sale.
Yes.
Let's put it that way.
A Black Friday sale. That's what you want all the time. For as long as possible. Until you're about ready to retire. And then you want the biggest bull market of all time. And if you're fortunate enough to be in retirement and in this bull market and you're 100% invested, just remember to be cautious. But most of our viewers are 25 to 45 years old, so they're in the early stages of investing and still have well over 2 decades to go. You're in an amazing opportunity, but you should root for stocks to go down. You should absolutely love that. And if you have an emergency fund for whatever reason, you can now stick it in a high yield in T-bills, 90-day T-bills making 5.4%. Now, is that going to continue? I have no idea. I have no clue. All I know is the 10-year treasury right now, it dipped below 4% yesterday, I believe.
Yeah, 3.9 right now.
Guys, look at that difference. Look at that disparity between you're supposed to have a higher rate for longer periods of time than a lower rate. And that's part of the yield curve inversion, which says there's more risk in the short run than the long run. The point is not to sit there and say you have to try to time the bottom. Remember, you're never going to buy at the bottom. You're never going to sell at the top. So if a process that you like, and you've learned a process and you found a company that you like, as long as the thesis is the same. Now remember, when a stock goes down, the news changes. When Meta was at $88 a share, the words around Meta were totally different than they are today. When Google was at $85 a share, the words about Google and the CEO were totally different than they are today. But it's your job to sit there and learn that process that we teach, that we implement ourselves. We love seeing our stocks go down. We love it. We had 2 stocks in the last 2 months that have gone up 50%. And Mo and I every single day go, God effing damn it. Right?
Yeah.
We want you to be in that same position with us. Wouldn't it be awesome to have that feeling? I love it on Twitter all the time when I hear people go like, oh my God, Paul, I bought this company, it's fallen, I'm buying more. Good for you. Now I don't know what their thesis is behind it.
But they think the fundamentals are maybe getting better.
Or, yeah.
The stock price is falling.
Remember, I own a company, PayPal. Again, don't own any company just because I do. But PayPal is still a growing business. And I literally had somebody on Twitter recently tell me, Paul, it's a declining business. And I'm like, wow. The message is so negative about PayPal that literally the objective truth is being denied. The revenue is going like this. And they said the revenue is going like this. There's no denying it is going like this. There's no denying it's going up. And that's what you want. You want irrationality out there. You don't want it for you. You want to be calm. And that's what we're here to do. We're here to calm you. We're also here to tell you, no matter what the market does, we're here to say, what is your process? What are you here to do? Dollar cost average in low cost ETFs or dollar cost average in the stocks you love as they fall.
Yeah.
Either way, you will likely do well with the right process. So will the Fed cut rates? Will the market crash? The truth is, Mo and I and nobody else in this world knows what's going to happen. And they're lying if they do. And if somebody tries to tell you they know what's going to happen, run away. All we can do is prepare for how we know we behave no matter what happens. And in either way, when the market goes down, we look at it as an opportunity to buy things we love at a cheaper price. Ryan Holiday once wrote that the Stoic philosopher Seneca said to be prepared for any possible scenario. And the one thing a leader is not allowed to say is, wow, I didn't think that was going to happen. Now, obviously, those situations do occur. But this absolutely applies in investing in markets. Stay in the game by dollar cost averaging and buying good companies at good prices. For all we know, the market could keep going higher and higher and higher. And if this is the case, we firmly believe that the best strategy is still the dollar cost average, buying month in and month out, no matter what the price is on low cost ETFs like VOO and SPY. Sometimes you'll overpay, sometimes you'll underpay, but over the long haul, you'll get exactly the return in the markets. If you want another video that we made about this, watch this next one called The Opportunity of a Lifetime Financial Event. See you in the next video.